Welcome back, dear students and scholars. We are now starting ASC 326, and this is a major turning point in financial instruments because we move into credit losses. In this first video, we will build the foundation, why ASC 326 exists, what problem it solved, how the CECL model changed the timing of recognition, and how to route different financial assets to the correct subtopic before any calculation begins. Credit losses matter because credit risk is not limited to banks. Trade receivables, loans, financing receivables, held to maturity debt securities, lease receivables, and available for sale debt securities can all involve future cash collections that may not fully arrive. ASC 326 asks a very practical question: how much of the recorded amount may not be collected? That answer affects allowances, credit loss expense, balance sheet presentation, and risk disclosures. Here is our learning path for this foundation video. First, we will understand why the old model changed. Then we will define what CECL means and why expected loss recognition is different from incurred loss recognition. After that, we will map the three ASC 326 subtopics, identify which items are in scope, and finish with the next measurement step. Today is not about complex modeling yet. Today is about building the correct route because a wrong route makes even a perfect calculation useless. Before ASC 326, US GAAP generally used an incurred loss approach. That meant an entity waited for a loss event to occur or become probable before recognizing a credit loss. The problem was that credit risk could be building well before the trigger was reached. Management, analysts, and credit teams might see deterioration, but accounting recognition could still lag. In good times, that made risk look too quiet, and in bad times, losses could arrive suddenly. Credit risk does not always ring the doorbell before entering the financial statements. The core shift under CECL is timing. Under the old incurred loss model, recognition waited for a triggering event. Under CECL, the entity estimates expected credit losses from origination or acquisition without waiting for a trigger. The estimate considers credit risk over the contractual term and uses past information, current conditions, and reasonable and supportable forecasts. So the mindset changes from reacting to a loss event to estimating expected collection risk earlier and more completely. This comparison table captures the three main differences. First, recognition trigger. The incurred loss model waited for a probable loss event, while CECL does not require that trigger. Second, time horizon. The old model focused on current known loss events, while CECL estimates expected losses over the full contractual term. Third, information used. The old model mainly used past and current information, while CECL adds reasonable and supportable forward looking information. That is the heart of the change. ASC 326 is organized into three subtopics. ASC 326 10 provides overall scope, definitions, and transition guidance, but it is not the measurement engine. ASC 326 20 is the main CECL model for financial assets measured at amortized cost, such as loans, held to maturity debt securities, and financing receivables. ASC 326 30 is separate and applies to available for sale debt securities. So do not use one credit loss model for every debt instrument. Classification decides the path. Before calculating anything, ask the routing question. Is it a financial asset or credit exposure? Is it measured at amortized cost? Is it an available for sale debt security? Or is it outside ASC 326 altogether? This order matters. Many mistakes happen because someone jumps straight to a loss rate or journal entry without first identifying the correct subtopic. In accounting, rushing into calculation before scope analysis is like entering numbers into the calculator before deciding what problem you are solving. ASC 326 20 applies to several important categories. Financing receivables include loans, notes receivable, and other lending arrangements. Held to maturity debt securities are included because they are measured at amortized cost. Trade receivables from contracts with customers and certain other receivables also enter the model. Lessor net investments in leases, certain off balance sheet credit exposures, and reinsurance recoverables can also be included. This is why ASC 326 is not a narrow banking only topic. It reaches ordinary business receivables too. Now, just as important, let us identify what is out of ASC 326 20. Assets measured at fair value through net income are excluded because credit risk is already reflected in fair value changes. Available for sale debt securities are excluded from Dash 20 because they use the separate Dash 30 model. Loans to participants in defined contribution plans, insurance policy loan receivables, not for profit pledges receivable, common control loans and receivables, and operating lease receivables under ASC 842 are also excluded. These exclusions prevent us from applying CECL where another model controls. Available for sale debt securities need separate treatment under ASC 326 30. These securities carry unrealized gains and losses in other comprehensive income or OCI, so the amortized cost CECL model in Dash 20 does not fit them. Instead, Dash 30 uses a separate credit loss approach and records credit losses through an allowance rather than a direct write down unless specific sale related conditions apply. The key point for this video is simple. Available for sale debt securities do not go to ASC 326 20. ASU 2022 02 also changed the credit loss landscape. It eliminated the separate troubled debt restructuring framework for creditors, which we commonly call TDR guidance. Loan modifications are now evaluated using the broader loan modification framework. The update also added vintage write-off disclosure requirements, meaning current period gross write-offs are disclosed by origination year for relevant financing receivables and lessor net investments in leases. We will not go deep into disclosure mechanics here, but you should know this update changed both practice and reporting. At a high level, CECL estimates the portion of the amortized cost basis that is not expected to be collected. Four information layers feed that estimate. Historical loss information gives the starting point. Current conditions adjust history for today's facts. Reasonable and supportable forecasts bring forward looking evidence into the estimate. And when forecasts are no longer supportable, the model reverts to historical information. Video 2 will handle the detailed measurement methods, including loss rate, roll rate, discounted cash flow, and probability of default approaches. Let us make the shift practical with Orion tools in 2026. Orion sells goods on 90-day credit and has year-end receivables of $500,000. No customer has defaulted yet, and no customer has said they cannot pay. Under the old incurred loss mindset, there might be no allowance because no loss event has occurred or become probable. But under CECL, Orion must estimate expected credit losses at the reporting date. With an expected loss rate of 1.8%, recognition does not wait for default. The calculation is straightforward. Orion has $500,000 of receivables and an expected loss rate of 1.8%. 500,000 multiplied by 1.8% equals $9,000. The journal entry is debit credit loss expense for $9,000 and credit allowance for credit losses for $9,000. The receivables are presented net. So $500,000 gross receivables less a $9,000 allowance gives a net carrying amount of $491,000. The entry balances, and the income statement reflects the expected loss now. This slide gives common first day mistakes. The first mistake is using a probable loss trigger under CECL, which belongs to the old model. The second is applying ASC 326 20 to available for sale debt securities, even though they belong in Dash 30. The third is ignoring certain off balance sheet credit exposures, such as commitments or guarantees, that may fall in scope. The fourth is treating scope as a shortcut and jumping into calculation. The fifth is forgetting forecasts. CCL without forecasts is like tea without water. Technically, you may have ingredients, but the result will not work. Now choose your answer. Which item is generally routed to ASC 326 20 for expected credit loss measurement? Option A is common stock measured at fair value through net income. Option B is an available for sale debt security. Option C is a held to maturity debt security. Option D is an operating lease receivable under ASC 842. Use the routing logic from this video. Identify the item measured at amortized cost and then lock your answer. The correct answer is C, held to maturity debt security. Held to maturity debt securities are measured at amortized cost, so they enter ASC 326 20 and the CECL expected loss model applies. Option A is wrong because fair value through net income assets are excluded. Option B is wrong because available for sale debt securities use ASC 326 30. Option D is wrong because operating lease receivables under ASC 842 are specifically excluded from ASC 326 20. Let us close the foundation. ASC 326 replaced trigger based incurred loss thinking with expected loss recognition. ASC 326 20 covers amortized cost financial assets and related exposures, while ASC 326 30 covers available for sale debt securities separately. The main discipline is routing first and measuring second. If this lesson helped you, please like the video, subscribe to the channel, support the course, and share it with colleagues who are studying US GAAP. In the next video, we will measure expected credit losses under CECL using practical methods and examples.